The new Fed chair changes everything. What Kevin Warsh means for your portfolio. Imagine waking up one morning and the single most watched piece of financial communication in the world, the document that guides every bond trader, every mortgage lender, every portfolio manager on the planet, just doesn't exist anymore, gone, because the new person in charge decided it was doing more harm than good. That's not a hypothetical, that's what may be coming on May 15th of this year. Kevin Warsh becomes the chair of the Federal Reserve in 10 days. And unlike most Fed transitions, which are polite institutional handoffs, this one represents a genuine philosophical break from 15 years of monetary policy orthodoxy. The way the Fed communicates, the size of its balance sheet, even the things it believes are in its job description, all of it is potentially on the table. If you've got money in bonds, in real estate, in growth stocks, or in small caps, you need to understand what a Warsh Fed means for your portfolio, because the market is already starting to price this in, and I want you to be ahead of it, not behind it. Let's get into it. Kevin Warsh is 56 years old. He's not a career economist, and that's actually one of the things his supporters point to as a feature, not a bug. He has a law degree from Stanford, spent time on Wall Street, and served on the Federal Reserve Board of Governors from 2006 to 2011, which means he was in the room during the 2008 financial crisis. He's currently a distinguished visiting fellow at the Hoover Institution at Stanford. What you need to understand about Warsh is that he's been skeptical of the Fed's post-2008 playbook for years, while central bankers around the world were defending quantitative easing, forward guidance, and expanded mandates. Warsh was writing and speaking publicly against all three. He's not coming in as a reformer who wants to tweak things at the margins. He's coming in as someone who thinks the Fed fundamentally overreached in the last 15 years, and he wants to walk that back. Now, is this confirmed? Let's talk timing. On April 29th, the Senate Banking Committee voted 13-11 to advance his nomination, a straight party line vote. That's historically significant. It's the first partisan confirmation vote for a Fed chair in modern history. The full Senate is expected to vote the week of May 11th. With a 53-seat Republican majority, his confirmation is virtually certain. Jerome Powell's term as chair ends May 15th, though he will stay on as a Fed governor through January 2028, the first time that's happened since Mariner Eccles stepped down from the chair in 1948, but stayed on the board. So the transition is happening. The question isn't if, it's what it means for your money. Let's start with the thing that gets the least media coverage, but may have the most immediate impact on markets: forward guidance. Specifically, the dot plot. The dot plot has existed since 2012. Every quarter, each member of the Federal Open Market Committee submits an anonymous projection for where they think rates will be at the end of each year, 1 year out, 2 years out, and long term. Those dots get published on a chart, and markets pass them obsessively. Hedge funds build models around them. Bond traders use them to price duration. Mortgage lenders use them to set 30-year rates. It has become, over 15 years, one of the most influential pieces of paper in global finance. Kevin Warsh has said, publicly and directly, that he doesn't believe in it. His exact words, "I don't believe in forward guidance. I don't believe that I should be previewing for you what a future decision might be." He's also said the dot plot creates a false sense of precision, that it implies the Fed has more foresight than it actually does, and that it hamstrings the committee's ability to respond to real-time data. So what happens if he follows through and kills it? Think about the taper tantrum in 2013. Ben Bernanke didn't even announce tapering. He merely suggested in congressional testimony that tapering might come. The 10-year Treasury yield spiked nearly 100 basis points over the following months. Almost instantly, markets panicked because they hadn't been fully prepared. Or think about Janet Yellen's first press conference in March 2014. She made an offhand comment that the Fed might raise rates around 6 months after ending asset purchases. Markets interpreted that as hawkish. Brief shock, stocks sold off. She clarified, and markets recovered. But the point is, one sentence, unscripted, moved markets. In a world without the dot plot, every press conference is potentially that moment. Every Fed speech becomes a market event. That's not necessarily bad for investors who can navigate volatility, but it is a structural change in how the bond market operates, and it means yields, particularly on the longer end, are likely to be choppier. Now let's talk about the balance sheet, because this is where Warsh's views get very concrete, very fast. During the COVID response, the Fed's balance sheet ballooned from roughly $4 trillion to a peak of $9 trillion by 2022. That happened through quantitative easing, the Fed buying treasury bonds and mortgage-backed securities to inject liquidity into the financial system. Warsh has his own phrase for what QE does. He calls it reverse Robin Hood. His argument is that it transfers wealth from savers, people with cash, people with fixed incomes, to asset holders, people who already own stocks and real estate. It's a redistributive mechanism, in his view, that the Fed never had a mandate to operate. The Fed has already been running what's called quantitative tightening, letting bonds mature without reinvesting the proceeds, and the balance sheet has come down from that $9 trillion peak to about $6.7 trillion today. Warsh has been explicit that he considers $6.7 trillion too large. He's framed further balance sheet reduction as, in his words, a substitute for rate cuts, meaning rather than cutting the Fed funds rate, which currently sits at 3.50 to 3.75%, he may prefer to keep rates where they are or even hold longer while shrinking the balance sheet more aggressively. What does that mean for you? The most direct effect is on long-term interest rates, the 10-year Treasury yield, the 30-year mortgage rate. When the Fed is buying bonds, it suppresses yields. When the Fed is selling, or just not buying, yields rise because someone else has to absorb that supply. More supply with the same demand equals lower bond prices, which equals higher yields. The 30-year fixed mortgage rate is still correlated closely with the 10-year Treasury. If the 10-year moves from 4.30, where it is today, toward 4.75 or 5%, you're looking at mortgage rates back in the 6.5 to 7% range. That has direct implications for housing affordability, for REITs that own commercial or residential property, and for anyone sitting in long-duration bond funds like TLT or AGG. History gives us a useful data point here too. When Powell sent a hawkish signal in December 2018, suggesting the Fed would continue raising rates on autopilot, the S&P 500 fell roughly 20% peak to trough in a matter of weeks. One sentence, later revised at a January 2019 press conference, reversed the entire move. Warsh is not signaling rate hikes, but the balance sheet compression message is structurally similar in its effect on the long end of the yield curve. All right, let's get to the part you actually came here for. Who wins, who loses, and what does this look like at the sector level? Let's start with the clearest loser, bonds. If you're holding long-duration treasuries, think TLT, which tracks 20-plus-year treasuries, you're sitting in the crosshairs of two simultaneous headwinds. Higher yields from QT compress bond prices directly, and without the dot plot anchoring expectations, yield volatility rises, which makes long-duration bonds riskier to hold. AGG, the broad bond aggregate, has shorter duration and is somewhat more resilient, but it's still facing an environment where the rate path is cloudier than it's been in 15 years. This isn't a call to sell everything, but if you have a bond allocation that's heavier on duration than you realized, this is worth reviewing with a financial advisor. Small caps are the third sector to flag. The Russell 2000, tracked by IWM, has a unique vulnerability. A large portion of small cap companies carry floating rate debt. Debt whose interest payments go up when rates stay high. They don't get the relief of a rate cut cycle, and their financing costs stay elevated. That's a double headwind: no cut relief and ongoing debt service pressure. Growth stocks are mixed, and the nuance matters. Unprofitable growth companies, the kind that were burning cash and banking on cheap financing, face genuine multiple compression in a higher-for-longer rate environment. But profitable megacaps are more resilient than people give them credit for. Apple, Alphabet, Microsoft. These companies generate enormous free cash flow, carry little net debt, and in some cases actually benefit from higher rates on their cash balances. QQQ holds both kinds, so the index-level picture is messy. The distinction between profitable and unprofitable growth is going to matter more than it has in recent years. Let's put some chart context around all of this. I want to look at four things: the S&P 500, the NASDAQ, sector rotation, and the 10-year Treasury yield. The S&P 500 is currently trading near the 5,650 level. The 50-day moving average is sitting around 5,580, and the 200-day moving average is down near 5,420. So we're above both moving averages, which is technically constructive. The key resistance level to watch is approximately 5,750. That's the ceiling the index has been struggling to break through cleanly. Support, if we see a pullback, is right around that 50-day at 5,580. The Warsh transition itself isn't necessarily a catalyst for an immediate sell-off, but if bond yields spike on the early confirmation news, or if his first press conference delivers more hawkish signals than expected, that 5,580 support level becomes the first test. The 200-day at 5,420 is the level you'd only be looking at in a more significant repricing scenario. The NASDAQ is near 17,800. It's held above its 200-day moving average, which is down near 16,900, and the 50-day is around 17,600, acting as near-term support. The key resistance is 18,200. Tech has been resilient in part because the profitable megacaps have been doing the heavy lifting. Watch this index carefully when Warsh's first formal communications come out, because the market's initial read on his rate stance will show up in the NASDAQ faster than anywhere else. Growth stocks are the most rate-sensitive on a valuation basis, so they reprice first. The sector rotation picture is telling you something important. Financials are the top-performing sector year-to-date, up 8.2%. Real estate is the worst, down 4.1%. That 12+% spread between the best and worst sector isn't random. The market is actively rotating toward the Warsh trade, towards steeper curves and rate-sensitive sectors, before he's even officially in the chair. When the market front-runs a policy regime change this clearly, it's usually telling you something worth paying attention to. Finally, the 10-year Treasury yield. We're at 4.30% right now. The critical level to watch above us is 4.50%. That's roughly where the 10-year peaked in the 2024 high-rate range, and it represents meaningful technical resistance. If Warsh's early communications are more hawkish than expected, or if the balance sheet reduction timeline is more aggressive than markets currently assume, a break above 4.50 becomes realistic. On the downside, 4.10% is the support level. If we see softer economic data or any moderation in his tone, that's where yields would likely settle. For bond investors, the 4.50 ceiling is the most important number to track over the next 90 days. Let me leave you with 3 practical things to think about, and I want to be clear, this is educational context, not investment advice. Every portfolio is different, and decisions should be made with your own advisor and your own situation in mind. The first thing to think about is your bond duration. If your bond allocation is heavy on long-duration funds, TLT specifically, or anything that's concentrated in 20-plus-year treasuries, this is a good moment to understand what you own and why. The bear steepening thesis isn't just a macro prediction, it's a structural argument about how the Fed will operate under Warsh. That doesn't mean you need to act immediately, but it does mean you should know your exposure. The second thing to watch in your equity portfolio is the financials versus real estate spread. That spread is already telling you the direction of the market's thesis. If you're underweight financials and overweight REITs, the current environment is working against you on both legs. Again, not advice, just context. But awareness of where the rotation is happening is half the battle. The third thing is the calendar, and this one is genuinely important. Mark 3 dates. May 8th is the next major economic data release, non-farm payrolls and the jobs report. A strong number will cement the higher for longer narrative and add hawkish fuel to Warsh's incoming tenure. May 11th is the expected full Senate confirmation vote, and May 15th is the actual handover when Warsh sits in the chair for the first time. Each of these is a potential market catalyst in either direction, depending on how the data and the narrative interact. Watch those dates. The confirmation is virtually certain. What matters is what he says on day one. Here's the core takeaway from everything we covered today. Kevin Warsh is not a continuity candidate. He's coming in with a genuine philosophical agenda, end forward guidance, shrink the balance sheet, keep the Fed in its lane. Each of those pillars has direct consequences for how different assets are priced. Bonds face more volatility and upward yield pressure. Growth stocks face multiple compression risk, especially the unprofitable kind. Real estate faces a continued headwind from rates and refinancing costs. And financials, banks specifically, are the structural beneficiaries of a steeper yield curve. The market is already pricing parts of this in. The sector rotation you can see in the charts today is not random. It's the early chapters of a trade that may take 12 to 18 months to fully play out. Now, I want to hear from you. What part of your portfolio concerns you most in a Warsh-fed environment? Drop it in the comments. I read all of them, and your questions shape future videos on this channel. If this was useful, please hit subscribe. We cover exactly these kinds of macro shifts with the data and the context you need to make sense of them. And remember, everything in this video is for educational purposes only. It is not investment advice. Please consult a qualified financial professional before making any changes to your portfolio. Thanks for watching. I'll see you in the next one.